Let's talk more about stocks and the commotion that we see down here on the floor of the stock exchange after the inflation report this morning. Joining us now is Satyam Pandey, Chief U.S. Economist at S&P Global Ratings. Satyam, thank you for joining. And what is your take on the inflation print that we got earlier?
Thanks for having me. It came in as expected. This, it was a 0.2% month-over-month rise on core inflation, which is a deceleration from what we had seen in the first quarter. So it's on the right path, what the Fed would like it to be. But still, there was something that did show that the consumer side of things, the spending, may be finding some headwinds here, which we had expected to come in at some point this year. So that's something to look out for, because real consumer spending had a negative handle month over month. It could be because Easter in the month of April, this was not the case for this year. It was in the end of March. Maybe there's some timing issues with that, but we would keep that consumer spending numbers, sort of keep that in mind when you are thinking about the rest of the year, because that spending number has been running well ahead of income. So when you are running well ahead of income, it's not quite sustainable. So maybe it is coming back down more closer towards your income growth.
So we always talk about this being the number that the Fed watches so closely. So how do you think Jerome Powell sees this number, and what, if any, impact might it have on Fed hikes or cuts the remainder of the year?
So I think Jerome Powell, he's been saying that he wants to see this 0.2% handle for several months, right? For several consecutive months, and which this is the first of that several months, hopefully for him. We think that if this were to continue, most likely you'll get the first rate cut by the end of this year. So most likely more in the fourth quarter. We've been saying December as the first rate cut, and maybe perhaps another 4 rate cuts next year when the economy does show more signs of weakness.
Satyam, we did see the chief executive of Bank of America recently come out and say that consumers and businesses have turned cautious on spending. This report, as you're referencing, gives us a sense of the consumer, but interesting to hear from a chief executive of one of the country's biggest banks that businesses are starting to pull back as well. Are you seeing signs of that?
Well, especially in the case of small businesses, we have been seeing signs of more negative sentiments in general. Their investments, their intentions to hire workers, it's not really been doing that well when you compare it to history. Same thing with the consumers, right? The consumers are being hit by higher interest rates, and especially with the inequality in income distribution, you are starting to see at least the bottom 50th percentile are getting hit by their real incomes not really quite matching what they would like to be at this point.
Now, on the other hand, we heard CEOs across the spectrum for months, if not the last year, talking about the likelihood of a recession. And Moynihan really all but ruled that out. Are we now to the point that we can accept a soft landing is the likelihood here?
Yeah, the most likely case still looks to be a soft landing here. There is a huge uncertainty around this baseline case. But looking at how the Fed is being patient, at the same time they are sort of, keeping the markets, even keel. It looks like we are going to achieve a soft landing this time around. But again, this is more sort of this particular monetary cycle that we're talking about. You may get a few rate cuts, and maybe they will have to again hike rates, but that's for some future time.
Satyam, we saw the former President Trump, convicted on all 34 felony counts yesterday. Shares of his publicly traded stock, ticker symbol DJT, down a few percentage points today. Do you expect this to have an economic impact?
My view in general is the U.S. economy, the policy that gets made is more about the House and the Senate, the makeup of those two chambers. It really depends on how that really makeup, comes out from the election. It does sort of matter who the president is as well, especially in terms of immigration policies and trade policies. But this time around, at least in terms of trade policy vis-a-vis China, both parties have been more hawkish. So I wouldn't see any much difference there. But again, it would really matter what the makeup of the House and Senate is.
Because the markets want to see mixed control, if you will?
Well, I don't know what the market wants to see, to be honest. I'm sure, somebody who is more, expert in the politics, there would be.
All right. Final question is, do you think at some point the Fed has to ease up on that 2% target and accept something well north of that?
Well, from what they've been saying, they don't need to see inflation rate come down to 2% per se. They just need to be sure that it is moving towards 2%, which we think that it's going to happen maybe late in 2025, early 2026. They just need to see the month over month annualized pace somewhere between 2 and 2.5% for, consecutive months. And I think they will be okay with that because monetary policy is at a restrictive place right now. They don't, they would probably hold for as long as they can before cutting. But again, some of the forward guidance, some of the communication that comes out can also work to their benefit, right, through the financial conditions channel. But for us, I think the next move is going to be an easing move rather than hiking, especially when you look at the economic conditions that is playing out.
Some signs that we are starting to see that softer economic data. Stocks up fractionally today. Satyam Pandey, Chief U.S. Economist at S&P Global Ratings. Thank you.